Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Happy to be back with you again today. I'm your host, Dr. Alan. I know you'll enjoy today's show, and I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. To leave a review and a rating, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either site, search for Real Estate Investing Abundance. Once you find us, leave both a review and a rating. Subscriptions are also vital to the show's success, so please be sure to subscribe on your favorite podcast app. It's free to subscribe, and you can unsubscribe at any time.
Enlightened investors, delighted to be back with you again today. I'm your host, Dr. Alan. If you're tuning in for the first time, I know you'll find great value in discovering how to develop financial independence built on solid passive real estate investing. To learn more, head over to our website, stevetucker.com, and enroll in our Enlightened Investor Circle, where you'll receive support for your investing goals, no matter what your level, experience, or expertise. Today's guest shares with us why self-storage outperforms all other asset classes during the current pandemic and why self-storage is an investment for passive investors like you. As an active investor, he focuses on the acquisition, development, and syndication of self-storage facilities nationwide. He currently owns and operates over 2 million square feet with over 13,000 units. The educational arm of his organization provides courses, tools, live events, and mentoring to help others invest in self-storage to develop financial independence. As the saying goes, freedom from tenants, toilets, and trash. He helps to create abundance for all through his mission focus, where he built 12 houses in Mexico and the Dominican Republic. Welcome, Scott Myers. Before we get into why self-storage is a viable option for our passive real estate investors, Scott, share with us a memorable experience from your formative years that helped you to be the person you are today.
Well, hello, Dr. Allen, and good to be with you. And, it's interesting. Recently, what I'm drawing upon in terms of an experience that has brought me to be the investor that I am today is that we syndicate a lot of projects and work on a lot of projects across the country. And I think one of them was that I'm drawing on recently is that we have a joint venture partner, two folks that are just not very friendly individuals, and they're not holding up their end of the bargain. And myself and our investors are the ones who are suffering as a result of it. And they're withholding information, and also some money has been hidden. We can't find, essentially called stealing. And so I had my bicycle stolen when I was in 6th grade. And that made me madder than all get out because there was nothing I could do. Even though I knew who did it, he was bigger than me, he was a bully, and I didn't have a way to be able to get my bike back. And so to this day, I'm still, when somebody steals from me and I feel helpless, like there's nothing I can do, and these folks are hiding behind some very high-paid lawyers that are showing them how to hide what they've done, it has given me even more of a resolve to continue to fight for my investors and for the integrity of our business, our brand, and again, for the rights of myself and all my partners in these projects.
Well, thank you for sharing that. That does sound like a pretty traumatic experience with the bicycle, and I can see how you can relate that to what is currently going on and the frustrations there for you and your investors. I do hope it all turns out.
I'm sure it will.
Turns out well. Well, you started out one property at a time, and that is how you advise others to do the same. So share with us a tad bit on how you actually got started on your journey in real estate investing and how that brings you to where you are today.
Well, I think like many people, Dr. Allen, when they get into real estate, it usually starts with a single family house for the most part. And so bought a home study system several years ago by Mr. Carlton Sheets and began following his methods, went out and found a single family house where I could assume the loan. It had a VA loan on it. So with a small amount of money down, I assumed that loan. It was currently a rental, so I already had a built-in renter. So then in the meantime, when we did some work on the outside, and then when the unit turned, we rehabbed the inside, refinanced the project, and then bought 2 more just like it. So we continued to parlay that into more houses, and we got up to the place where we had about 78 houses. and then decided that we wanted to begin to work on getting out of the business, the active side of it, and really ramping things up and have property management in place. And in order to do that, that meant multifamily. So started buying up apartments, small to medium-sized apartment complexes here in central Indiana. Had about 400 of those, and then realized that all they did was really compound the amount of work that we had, even though that we had property managers and a property management company. At the end of the day, the buck stops here. There were still lots of challenges and lots of things that needed my attention, and didn't really have all the freedom with my time and the cash flow like Carlton Sheets had promised in his course. And so at that point, I decided to begin looking around at the different asset classes in real estate to be able to invest in. And I realized that the bulk of my time was spent really babysitting tenants and my management companies and my contractors, from the rehab side to the turns. There's just a lot of moving parts to it. But if I wanted to eliminate that, it means, as many people say in this business, we'd love rental real estate if it weren't for the tenants. So the only way to get away from that is to invest in parking lots or self-storage. And you can't really build a lot of value into parking lots, but with self-storage, you certainly can, and even more so than in multifamily that we found, because your dollar buys more units when you have rental increases, rate increases, and you begin adding on the ancillary income streams like renter's insurance and selling locks, boxes, and moving supplies to all the folks that come in when they move in, and the multitude of other ways to be able to increase the value. We realize that exponentially you can increase the value of a self-storage facility versus what we were seeing in our houses and apartments, and certainly better than parking lots. And so I began to look into the asset class, going to the trade shows and really speaking to as many people as I could who got into the business. At the time, there wasn't anybody like our company teaching people how to invest in self-storage. It was just the trade shows for people that were already in it. So I paid for a mentor, I paid for a consultant to help us get into our first facility, and saw the light and realized that with the lien laws and self-storage, if somebody doesn't pay, you put a lock on their unit. And then after 90 days, if they don't pay, you sell the goods, the contents off, versus habitational real estate where, if you're lucky, you walk out of court with a little yellow or pink piece of paper and you get a little bit of money after 90 days of trying to get them out. And also the fact that when you do turn a unit over in self-storage, it's just a metal box on a concrete slab. You blow it out and you move in the next person waiting in line, versus the huge cost of turning a unit with either cleaning the carpets and painting versus, doing a lot of damage control and replacing the carpets and, all types of other repairs. I realized that, this is the way to go. And so we began to sell off all our houses and apartments while simultaneously ramping up our portfolio in self-storage. So in the beginning, buying existing facilities, value add, where we could increase the rents, increase occupancy, buying these 5-acre parcels with buildings on 3 or 4 acres where we could expand and build more buildings. And then eventually we got into conversions and buying vacant big box warehouses or retail centers that went out of business and converting them to self-storage, and then ground up development as well. So that's where we find ourselves, is in nothing but self-storage right now. We acquire, we develop, we convert, and then we developed an education and a consulting business along the way. And we opened that in 2007 and began teaching people how to do the exact same things that we were doing, and then ultimately partnering with them as well. And syndicating too, bringing along those passive investors that want to invest alongside of us in our projects and get a piece of equity for doing so.
So when did you start into self-storage?
So I began investing in real estate in 1993 and then began investing in self-storage in 2005.
Okay. So about 15 years that you've been into the self-storage aspect of that. So in terms of your rates of return, comparing your self-storage to your experiences with multifamily, what are the differences in your rates of return, particularly for passive investors?
Yeah, so we syndicated one apartment project and ended up right around a little over 9% IRR on that project. And this was several years ago. And we brought 2 investors into the project. And the project didn't turn out as well as had planned after a large increase in property taxes by the municipality to pay for their new sewer system that they had failed to budget for several years. And so what we had projected to be roughly a 17% internal rate of return ended up being a 9%. So maybe not a fair comparison, but then when we get into self-storage, most of the projects that we've done over the past, I'd say 5 or 6 years since we've been raising equity on these projects, is anywhere from 17% upwards to 25% internal rate of return. And most of our projects are anywhere from a 3-year hold on a turnaround project, an existing facility where we're just turning it around and leasing it up and maybe doing a small expansion and then selling, to our ground up developments, which take up to 5 years. One project is going to go about 6 years or so. And those returns, again, anywhere low end 17% IRR to 24%, offering anywhere from an 8 to a 10% preferred return. And then roughly a 1.8 multiple to 2.2, 2.3 times return on their equity. And that's where most of our projects fall, and where we model them out so that we attract more folks to get our projects funded quicker than others.
We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes, from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. So that is interesting. You projected a 17% internal rate of return on your apartment syndication. It came out to 9%, primarily because of taxes on an infrastructure tax that was not anticipated. Do you suspect that perhaps you run into that kind of thing more with multifamily than you would with a self-storage? Couldn't a self-storage run into the same situation?
They could, except that this was based upon the size of the sewer pipe that is coming, or the pipes that you connect, and how many of them into the city system. And so that's how they based the tax, is on that. So they had a crumbling infrastructure in terms of all the sewer piping. So by contrast, self-storage, nobody lives there. So we don't have heavy usage on the sewer system or infrastructure. So I suppose that if they came across, any infrastructure from road to schools or anything that was underfunded within the city, and the city just decided to reassess taxes for any reason, sure, it could happen. But in this case, it was directly tied to the water system that they had underfunded, and apartments obviously have a lot of water coming out of it. So a lot more susceptible to usage and consumption taxes of that nature in multifamily than you would in self-storage, where nobody lives there. It's just concrete boxes on metal slabs that sit there.
Right. Well, you definitely are. I mean, you still are an active investor in terms of your self-storage, but as you have described to us, it's considerably less active than apartment investing. Well, talk to us a little bit about the difference between active investing and passive investing.
So I can answer that a couple of ways. I'm still active on both ends. And yes, on the storage side, I guess what we realized is, because there are fewer moving parts, because we don't have to manage tenants and toilets and trash and the contractors, with so much work being done on the turns or on the rehabs, and then the property management companies, it's a pretty well-oiled machine. It's not a simple business, it's not an easy business, but we do have simple processes, and we manage the systems that are in the business. So we've achieved what Michael Gerber calls, the E-myth, where we have systems running the business and we manage and tweak the system. And the good news is, with self-storage, because the human factor, the tenant factor, is taken out, and we have these safeguards in place where if somebody doesn't pay, we lock them out, we sell their stuff. It's pretty simple. It's pretty straightforward. So we can budget from one year to the next, from month to the month, and understand pretty much, without a whole lot of hesitation and without a whole lot of surprises. We don't have emergencies. We don't have pipes that are busting that cause, issues. We don't have moratoriums on, evictions like we've had over this past year during the pandemic. We're not affected by those things that all occur as a matter of having people living in your buildings. So from that standpoint, it's much easier to work on the business rather than in the business, and just work on scaling it. My time is spent working with my staff and training them on our systems and making them the best they can be. But that's the 20%. The 80% is then spent on raising private equity and then finding deals and matching them up. So the passive side, and speaking specifically to the folks that we work with that come and invest with us, in some cases, some of them are our students that have come through, that we've mentored, that we've helped and consulted, and they've decided that, gosh, the returns that they could get investing passively are close to what they would probably get on their first deal, doing it on their own, and maybe not doing it 100% correctly or maximizing their returns. And also in commercial real estate, as you know, if you're going to use your own funds for the down payment on your first project, you may be pulling retirement funds out or just cash, anything that you can utilize your liquid capital to be able to put down on a project. And if it's $1 million property, that's $250,000. You can only do so many of those before you have to then move on to syndicating or doing something different in your business. Whereby some folks, if they want to get involved in the business and be an owner and they have $50,000, they can invest in a project with us. They are an owner. They get equity. That means that they get the depreciation on their tax returns and a K-1 at the end of the year. They also get a chance to learn about the business by way of our reporting on a monthly basis, our webinars on a quarterly basis, and then being able to ask questions and then being an investor alongside of us, albeit not active. We are open and transparent as to everything that we're doing in the project all along the way, so that they get a sense that they're doing this as an owner. And then also the added benefit of being able to hold their head up high and put their shoulders back when they walk into a bank to get their first loan on their own self-storage facility or commercial real estate, whether it be multifamily or mobile home parks or what have you, because they are an owner. They have an equity share in a project. And so that many times some folks will invest with us so that they can get that on their resume and then begin to use that as a springboard to creating their own business venture and launching their own commercial real estate business. So multiple benefits of being on the passive side, all of them of the ownership without having to do the ownership, and then being able to come along for the ride and learn it so that they can go out and do their own.
So it sounds like passive real estate investing is a good way for people who are actually fulfilled and satisfied in the professions that they are in and don't want to leave those. They can do it passively through syndications. And from what you're saying, they can expect really the same kind of returns that they would get if they were actively involved in the organization.
Mm-hmm. And that's what our community is made of. The folks that invest with us passively, we do offer education along the way. They're looking at the various projects that we have, and we have a number of groups that I attend, masterminds that I belong to, whether they're medical professionals or in other fields, and they're wanting to build some passive income and prepare for that time when they're selling their practice or selling their own business and supplementing their retirement, or along the way learning about real estate. So this could be an alternative, and then they can jump in and do it either passively or actively once they have moved on from their current career.
Well, what would you say is really the baseline knowledge information that a person should have before they jump into a passive real estate investment? Because it's going to be, I've seen some as low as $25,000, but generally it's going to bottom out at about $50,000 and can go up from there. And so that's nothing to sneeze at. So what's the basic level of knowledge and information a person should need?
Mm-hmm. So I think, and it's a very good question, Dr. Allen, certainly we're fortunate. We've built an incredible business. We've been around for a number of years. If you look at self-storage and Scott Myers, you can find a whole lot. I forget how many tens of thousands of impressions to be able to find out what we're doing. So I think first and foremost, you need to vet the person that you're getting ready to invest with. So do your due diligence, do your background checks. Do they have a history of meeting their returns? Do they have a number of deals under their belt? Or is this the first one that they're doing and they're going to experiment with your money? I think that's first and foremost the stay power, and the fact that somebody has been around that you're getting ready to invest with. They've been around for a while and they've done well by their investors. They know the asset class and they've been able to replicate this. So that would be first. I think second of all, you need to understand the asset class to a degree as well, so that when you're looking at a presentation by way of a webinar, or you have a prospectus or an offering memorandum, that when they're looking at and they're showing their projections and their baselines and where it is now and where they're going to take it, that you have some frame of reference that comes from experience or knowledge to know that, okay, I can see that, and you can feel comfortable plotting the path and the points to profitability in this project to say whether it's either realistic or that's what I've seen before, that seems about right for this industry. So gaining that experience and understanding the asset class that you're going to be able to invest in. And then I would say to lurk a while, get on somebody's list on their website, join their calls, if they have other forums or other ways to be able to communicate with their community, join that. Spend some time with them, understand if their goals and their core values match yours. And if this is somebody that you truly believe in and that you want to go through your business life with, that is key before you plunk down $50,000 or more in a project because you're going to be partners with them for 4 to 5 years. And so you want to feel comfortable with this person. And, there's one thing to know, like someone, but then you need to trust and verify and just determine exactly who this company or this individual is before you invest with them. So if I could summarize all that, Dr. Allen, it's do your due diligence and make sure that, it's one thing to look at the documents before you sign on it and wire money. It's another thing to really know who it is that you're investing with.
Good advice there. So in terms of when you are investing, you can invest for cash flow or you can invest for value add projects that may not necessarily be cash flowing. What's your advice in terms of going for the cash flow as opposed to waiting for value add opportunities?
Well, first of all, my job and my role is not to give advice. I can share experience and also the facts and then let people draw their own conclusions. But you're right. Investors usually come in two flavors. They're looking for cash flow. We've seen a lot of that during the pandemic. A whole lot of folks that have been let go, released from their jobs, or they close their businesses, and now they have access to their retirement funds and they can move it over into a self-directed IRA. The question is, do they need to replace their income until they find something else? And so they need to put their money to work in something that is cash flowing, where they can receive payments from that and cash flow from it? Or are they in that wealth accumulation and wealth appreciation mode where they don't need it right now and they're just looking to be able to grow their retirement so they can either retire quicker or can be able to retire a little bit better? So I guess the way I would answer that, Dr. Allen, is that it just depends on the person's situation and what it is that they're looking for. In terms of an investment, you'll see some of them structured with a preferred return and they begin to cash flow right away. If it's an existing project where they're creating value add, but there's already an income stream in place, it is a rental real estate that already has a base of renters, versus a development project where it may be a year, 2 or 3 years before there's any cash flow that comes out of the project. And then there's some cash flow in year 3, a little more in year 4, a lot in year 5, but then the sale or a refinance, and then comes the windfall. And for those projects, typically they have a higher IRR because they have a higher multiple on the back end because it's a little riskier and the developer has to offer a little sweeter returns compared to the rest of the market that is offering something that's more safe and secure that already has an income stream in place. So multiple things to look at when you are determining which way to go with an investment for retirement or cash flow. But I think that in itself is what determines which way to go. Is do you need the cash flow now or can you defer?
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
Well, numbers are, of course, important when making any kind of investment decision. Give us some examples of a typical turnkey investment and talk to us about the investment, the expenses, the NOI, cash-on-cash returns, and the internal rates of return in conjunction with a typical project.
So most of the projects that we're doing right now, if you want to call them typical, are development projects. We do have one right now. We do a lot of self-storage. We do storage of all sorts. We have one that we just did a webinar earlier this week. It's a capital raise for an airplane hangar and luxury storage project that's located out in Colorado. So we're building out a park that is going to be condos that we will lease as well as sell for airplanes and high-end vehicles and really that luxury, if you want to call them man caves, located out at the FNL airport. That is one in which it's a quasi development, but we're also going to be selling along the way. So we're offering a 10% preferred return on that particular project. The IRR is just below 20%. I think it's at 19.83% is what we have projected. And it's a 1.8 times return on their money. Cash on cash, it really doesn't come into play until later in the project when it begins to cash flow. But all in all, it's going to be somewhere, the overall project is going to be somewhere in the 70% range. And so average annual returns is going to depend on the sales of the units versus what we rent. And so we've been very conservative in our projections on that. And now we don't know exactly where that's going to land because we do have a lot more folks that are looking to buy now with a waiting list of folks that are looking to buy than we thought would be actually renting them. So we're tweaking the model as we speak, but that also means greater returns for the folks because they get their money returned faster.
So you say you're focusing on development rather than existing.
Mm-hmm.
What is the reason for shifting from existing to development?
Really not a shift in focus, Dr. Allen. It just depends on, we've got a number of folks that we've been working with all over the country over the years, teaching them the business, consulting with them that are already in the business. And so we have a lot of projects that are brought to us. And so we're very selective in the projects that we take on, but it ebbs and flows. There may be a time where we take 2 to 3 development projects on in succession, and then, which is kind of heavy for us. And then all of a sudden we have a lull, and then we may take on 1 existing facility, or then we may take on 4 existing facilities that are value add. It really just depends on what that looks like. But during the pandemic and as we head into a recession, self-storage is in huge demand. And so, yes, we have been looking towards more towards development because we do have the equity behind us and we've got the team where we can go out and develop. We just look for the site, the zoning, what is going to get us to market the quickest. And right now, our focus is on conversions because retail, we've all but put the final nails in the coffin in retail with this pandemic and the rise, again, even more so of Amazon and everybody buying online, that there are a lot of retail strip centers, big boxes, freestanding buildings from these companies that have gone under, and we're buying those up and converting those into self-storage as well. So those are the projects that we're seeking, which is kind of a mix in between. We've got shorter time to market because the shell is already built. We just put up the walls and the doors on the inside and clean up, if you will, the shell and make it conducive to a storage environment. Sometimes putting a drive-through where you can drive through the middle of the building, or other times it's just buttoning it up and making it look more like a self-storage facility rather than a grocery store or an industrial building.
I'm surprised that is feasible because I would think that retail per square foot is going to be considerably more expensive than self-storage per square foot.
Well, it's all about supply and demand, and there's no new retail opening up. They're shuttering, all across the country right now. Retail is dying a very, very quick death. And so there are many, many buildings out there for pennies on the dollar because no retail is coming in to fill it because nobody's going to stores to buy anything anymore.
Right. Yeah. Well, interesting. So you started out in 2005. So you have been through the 2007, 2008, 2009, what they called a recession, but felt like a depression for many, many people. So what is it like in self-storage to go through a reset on our economy, such as 2005 to 2007 to 2009?
Well, we don't celebrate pandemics and we don't celebrate recessions. The self-storage industry does extremely well. This will be my 3rd recession in self-storage. And again, we don't celebrate it, but we've been looking forward to it. And we're starting to see the effects right now with the unemployment rates as high as they are. And pretty soon with more evictions opening up and people being now forced out of their houses and apartments, once those moratoriums burn off, and we're already beginning to see that, they downsize or they move back in with each other, they move back home. And their items go into storage. Businesses close, but their excess inventory and perhaps equipment, even office furniture, things of that nature goes into storage until they either sell it or until things turn around again and they can either expand or start up their business again. So as we've seen in the past, in every recession, self-storage is right in the top 5 sectors of the economy that does extremely well during a recession. Liquor is always number 1. We're never going to be able to topple liquor when it comes to a recession, but self-storage has been as high as number 2 in some areas of the economy. And but usually in the top 5 for that reason. We also see that there is less building, there's less development at that time, just by nature of there's less construction of anything during a recession because the banks continue to close their doors, close off the faucet to development funds in lieu of looking at existing facilities, existing businesses that have cash flow in it rather than speculative type investments. So a recession is really a perfect storm for self-storage. You get fewer product, fewer units coming online in the marketplace. And we have a huge surge in demand because of businesses downsizing, individuals downsizing, that it truly is a perfect storm. So vacancies go down, rates go up. And it's during that time that those of us that still have lending opportunities that have done well and also have passive investors to come alongside of us, we continue to build facilities, but we really turn more into buying existing facilities at that point just to try to keep up as much as possible with the existing demand that's out there during a recession. So during a pandemic, we've also seen very, very similar, if not the same types of increases in demand. And that is when we first headed into the lockdown, colleges closed, they sent everybody home. All the college stuff went into storage. Then businesses shut down. There was a lockdown and everybody exited the office buildings to go home to work. At that point, not all, but wage earners that were now working at home, 1 to 2 of them had to find a place in the home to clear out a bedroom, clear out the dining room, put things in storage to make a workspace for 1, if not 2 wage earners. And then the businesses that shut down, that lost their leases, that lost their buildings, that excess inventory, all the items that were involved in their business went into storage. And so it was, again, a triple whammy, yet again, a perfect storm for self-storage. And we're riding that wave right now, year over year and month over month. Occupancy increases and rate increases are the best that we have ever seen. And we just saw another recent report, results from 2020, let alone the first quarter, but self-storage outpaced all other asset classes. Self-storage and industrial, go figure, Amazon and their warehouses bolstering industrial. Self-storage and industrial sector were the only 2 sectors in all of real estate that posted positive returns in the REIT report that came out at the end of 2020, and everything else, all of the real estate asset classes was in the negative and by far. And we're also leading the pack in the first quarter in terms of returns as an asset class and as a sector in our economy. The self-storage train just keeps rolling along, and we've been very, very, very thankful for it and blessed to be in this sector of the economy right now.
Well, lots of positive things, sounds like, come along with self-storage investing, but any investment has its risks. So what are the risks with investing in self-storage?
Well, I think the risks that we've seen, most of the risks that we've seen is just by people thinking, or maybe taking 2 of the 3 things that I've said on this podcast or anywhere else, is saying that, it's a simple, predictable business model as long as you put systems in place and follow the system. And people think that it's an easy business, and that's not the case. And so they treat it like a hobby. They don't walk the 4 corners of their business if and when they buy a self-storage facility. They don't put the best business practices in place, the best systems and the best people behind the counter and the best people minding the store. And just assuming that it's a set it and forget it business. So that's one. The other is due diligence. People fail to learn, like many investments. Well, let me take a step back. Like all investments, you make your money when you buy it. And if you don't know what you're doing, many investors make a mistake because they failed to go out and learn the asset class. They failed to understand what are the baselines and the benchmarks? How are you overpaying for? How do they know they're overpaying for a facility? Because they didn't understand exactly what went into the underwriting and what the baselines were as far as an expense ratio for each and every one of the items in the business. So I believe it's just lack of preparation, lack of education, being too overzealous to get into the asset class. We've got a lot of people looking at self-storage because it's doing so well. And there's a lot of folks that are getting into it that aren't doing their own due diligence, and they may end up not keeping those facilities in the future. So I think those are the main things. And again, it's probably the easier answer, but that's what we've seen so many times, because that's what we do in our consulting business, is clean up the messes from people that just didn't do a good enough job when they got into it in the first place.
Enlightened investors, will be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time.
Sounds like some great advice there, and certainly you have been around long enough to know what you are talking about here. Before we go into our last segment here, Scott, how can our viewers and listeners get in touch with you?
Sure. Well, you look up Scott Myers and self-storage on all the socials, and you can't help but find me. We've been out there for quite a while. But also, if you're looking to learn how to get into self-storage and do this actively as an active investor, go to selfstorageinvesting.com. selfstorageinvesting.com. We've got a lot of free resources and other resources to assist you in getting into the business and growing and scaling it. And for those that are interested in passively investing and come alongside of us, go to passivestorageinvesting.com. You can look at our current projects that are closed, projects that we've done in the past, and get a good idea and a sense for what we look for, how we go about doing it, and again, the types of projects that we look for that we invest in with our equity partners.
Well, Scott, let's take a step back here from the business aspect of who you are, and let's take a look at who you are as a person and as an individual. So share with us one of the most difficult experiences in your life, and how did you come through that time, and what did you learn from that experience?
Yeah, I had a bad partnership many, many years ago. It affected the personal side as well as the business side. And I think personally, it's very, very difficult to be able to recover from a financial trauma like that. And I think all the ideas and thoughts that go through your mind. But at the end of the day, sometimes you just can't control a scoundrel or an unscrupulous person from, making a mess of the business that you got into with that person. And so I think unfortunately that made me a little less trusting of my fellow man. But on the business side, what that did is it allowed me to then be a lot more discerning in who I get into a partnership with. And then also, as you well know, Dr. Allen, is that, they say there's no bad partnerships, there's just bad contracts. And we learned a lot about that the hard way, but also, that has helped us in how we move forward from there. And how did it affect us personally? I said, yeah, just looking at people a little bit differently and having to be a little bit more skeptical, unfortunately. The positive side of that is that as difficult as that was, and for my wife to see that happen and how that affected us financially for a short period, they just made us a lot closer and a lot stronger, as we navigated through that. Because when your business is your business, and early on, your business bleeds into your personal life. It's one and the same. And so from that standpoint, I think there's many folks that can look at things and to say, hey, this happened to me, or this is happening, and they're in the middle of it, and they're saying this is happening to me. And we tend to look at it as if, God's going to get us through this. And this is really happening for us and for me. And it's to be able to learn to come out of that. And even though, we didn't really lose the battle, but we came out pretty, bloodied and scarred up, but we absolutely are winning and have won the war since then. We know now, we are battle tested and know what to do going forward.
It's interesting when I ask this question of most people, most everybody is never really happy that they had to go through that, but they're grateful for the experience because it has helped them actually to be, better people in a lot of different ways.
That's where we grow.
Yep, indeed. Not necessarily fun, but I guess growth comes from a lot of pain oftentimes.
I agree 100%.
Well, what are you most grateful for in your life today?
Oh, just the peace that I have after going through some challenges in business and in the past now, looking back on the things that I used to worry about, none of those were very big on the other side of it. And even the things that I worry about were all unfounded. And so just realizing that, no matter what challenges that come our way, there's blessings on the other side of it. We'll be stronger on the other side of it, and just content, going through this past year and the challenges in our businesses. And certainly for a short time, there was hold our breath and, oh my gosh, what's going on? Until we realized that, oh yeah, we're in this space that benefits from it. And just, any other challenge that comes along, just having that knowledge of knowing that, even if I lose it all, I know how to build it back again, but I know how to head these things off. I know how to handle these things. And so, what seems like a big challenge in the moment usually never is. And now, having the experience behind us now of knowing that no matter what comes our way, it's all going to be good. And even if it isn't, then, it's not so bad if I have to start all over again, because I have my health, I have my wife, I have my kiddos, and that's really all that matters. And so just that contentment that comes, having that relationship with my maker, and knowing that he will provide no matter what.
Well, an interesting perspective there, built on a sense of confidence and success. Good place to be there. Well, in the introduction, I mentioned a little bit about the mission work that you do. So tell us a little bit more about that, because that is an aspect of who you are and how it is that you are helping to actually create universal abundance and well-being for all beings in this world. So talk to us a little bit more about that mission experience, and maybe there's other things as well.
So years ago, a friend of mine in business, he ran a very successful security company, and he grew grew it into a large agency nationwide that was then eventually bought by a major player. And so he did very well in the formative years. And one thing he would do with all of his employees is he would take them on a short-term mission trip. It was through Youth with a Mission, or YWAM, and their division called Homes of Hope, where they would go to the Dominican Republic or to Mexico and build a house. And his company would pay for the house, to furnish it, pay for their travel to go there, and all their employees were really strongly recommended to go at least once, and he would pay for that. If they wanted to go again, it's a small reattend fee. And to have that experience of just being out in the mission field and being able to have an open hand and to help and to build a house for somebody and give it to a deserving family who has fallen on hard times in some of the poorer parts of the world. And then just getting that idea and that sense of what it's like to give back and out of abundance. Really no goal in mind, but certainly would hope that someday that they would begin to take that back home with them, and to be able to just now look to help others back home to whatever that fashion that is, whether it's just volunteering anywhere at a soup kitchen or assisting at church, or really just having a different spirit about how they treat their fellow human being and even the people in their household. And so this gentleman and I, we've been in business together for a while, but then our kids started going to school together, and he opened this up and offered it to the kids at our school. And so our kids came home and said, hey, Dave's going to take us on this trip, and all we have to do is pay for the plane tickets to get there. And so we went on this mission trip, took our 3 kiddos, and they were changed. Their lives were changed, like many people's lives are when you go to places where these people wake up every morning sleeping on a dirt floor, and yet they're happy. The kids are happy. Family is close because they rely on each other, and they operate from a little different place. And so I told my wife, I said, I want to do this. We've got to figure out a way to put this into our business. And so we made the commitment to tithe, to take 10% of our profits in our education business and once we had enough money to go on a house build, we knew what the budget was, that we would then invite our friends, family, coworkers, partners, staff, anybody who wanted to go on this trip, that we would take them on the trip. All they had to do is pay for a plane ticket to get to the airport, and we would handle the rest. And so we did that, and our business began to take off. No surprise, no coincidence. And so what started as one house has now become 2 houses per trip and 2 trips per year. So we're building about 4 houses a year. With the exception of last year, we did sneak one in November when the borders opened up. We were only the second group to come into Mexico after they opened back up again to build a house. And now we're getting ready to go again in May to build Memorial Day weekend. We're building 2 more houses, and then we'll build, so long as everything is open in November, we'll build another 2 houses and get back on track. And again, taking anybody who wants to go along with us and introducing them to a very family-friendly 4-day short-term mission trip. And we pay for all the expenses except for their ticket to get to the San Diego airport.
Fascinating work there. So in 4 days, you don't build an entire house, do you? Or do you?
Well, we build the house in 2 days because the other 2 days are travel days. So, it's a 16 by 20 or a 20 by 20 house, no plumbing, very rough electrical, and 1 or 2 bedrooms in it. Mm-hmm. So, and it is stick built. We frame it, we build the trusses, put shingles on it, 2 windows, a door, a wall inside, drywall, no mud, no sanding, just trim strips in between, and then paint the whole thing up. And at the end of really a day and a half, the concrete slab is there; it's in place when we start. So to be fair, but in a day and a half, 2 days at the most, with about 25 to 30 people, we descend upon this pile of wood and saws and nails and screws and shingles, and we put the thing together and hand the keys off to a deserving family.
Wow, impressive. Well, imagine that you have lived a full and meaningful life, and as you lay on your deathbed, what do you look back on your life with the greatest sense of satisfaction and fulfillment?
I guess it sounds pretty cliche, but I hope I'm surrounded by the people that love me the most because they knew me the best. And I hope that group is large, but at the very least, it's my immediate family. So yeah, I guess that's it. It would be sad to be alone, or people that wouldn't even bother to come at that point, but to be surrounded by family and perhaps some close friends at that point, to just know that I made a difference and that it meant enough for them to come and see me in the end days, I suppose.
Well, Scott, it has been a pleasure visiting with you today. So thank you for being on the show.
My pleasure, Dr. Allen. Thank you.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures great and small flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.